Hello, good afternoon. You're tuned into Closing Trades on ET now. I'm Anisha Jain. With me is Aisha Faridi as well as Nikunj Dalmia. And for the markets, it's a bit of a sideways move. Monday morning blues is definitely which is impacting the market mood. But at least off the lowest point of the trading session, 17,700 thereabouts is where we are at. A bit of a resistance at the 100-day moving average. But on the downside, at least, there's support near the 200-day moving average level. So we're not falling too sharply as we speak. Nifty IT index hit a 23-month low on an intraday basis. There is a recovery from the lowest point of the trading session when it comes to IT stocks as well. But having said that, Infosys as well as HDFC Bank are contributing almost 130, 140 points to the downside. So the earnings have been something which have been muted, and we are seeing the reaction in the stock prices. You have ITC, however, which is sitting at a record high level, so surpassed the level of 400. And in fact, FMCG as a whole is bucking the trend today. So whether it's Nestle, HUL, they're all reacting positively. And then also you have some sort of spike in the PSU banking names. So SBI, Punjab Sind Bank, Indian Bank, these are some of the counters which are bucking the trend. But I have to say the talking point clearly is IT, Aisha.
Yeah, and we were just looking at the historical data. April seems to be a bad month for Infy, right? Because if you were to just stack up the steepest falls that Infy has had in the last historic count. So yes, September 08, that's when the Lehman crisis happened. That of course, the whole market said, as did Infy. It fell about 20% that time. August 2011, again, recessionary fears in the US, Infy fell 16%. And now comes the April underperformance, or the jinx of April, if you would want to call it that. Weak numbers, slowdown fears, April 13, 23% is the fall that Infy saw. April 2022, as recent as that, last year, weak numbers, general market weakness, Infy tanked 18%. And then today, of course, we've seen a near about 13% fall. Again, slowdown fears, weak numbers, all of the reasons pretty much the same as were there last year. But yes, besides what you're seeing today, which is just a marginal recovery in Infosys, if you were to just stack up how from that previous April 2022 low, how Infy has done, and if you were to just stack up the 52-week performance of Infosys, it definitely has been one of the better performers. But I guess the question is it too late to sell or too soon to buy?
Both. Too late to sell. Why? Because a year from now, significant amount of fog would have lifted from the windscreen in terms of where the real economy has moved. B, it's too early to buy because you're not really getting a company which was projected to grow in double digit, in middle single digit, and I don't think market has seen that kind of an peak compression. B, it's not a stock which has fallen 50% in the run up to the numbers. Infosys has done rather well in terms of where the positioning of the IT index has been. So you're not getting the stock. It's too late to sell. Why? Because if you sell now, you pretty much will be selling it close to the low. But if you really want to buy now, you may be perhaps better off waiting for some more, maybe a slightly weaker patch in the market, because Infosys is a heavyweight, and if there is selling in the Nifty of this ETF selling, it will actually hold true. But tell you what I like, while we are spending disproportionate amount of time in discussing Infosys, remember there was a time when Infosys would sneeze and markets would catch a flu. No, that's not happening. Wipro has recovered from the day's low. You got smart recovery which is there in a TCS. Tech Mahindra marginally above from the day's low. LTT Twins up down only 5-6%. TCS down 2%. So bottom line here is that what's happened in Infosys, markets are recognizing that, but they're also acknowledging that Infosys is a great IT company, but not every Indian IT company is perhaps being cut from the same cloth. That's the bottom line.
Yeah, but Kunal, for the rest of the market, actually, let's talk about IT, considering that was weighing heavy, as did HDFC Bank. What's now looking at for the charts for these two?
So I think after this kind of a initial gap down sell-off for Infosys, TCS, and then most of the other IT names, Persistent, Wipro, Tech Mahindra, and with the bounce back which has come back into TCS and Infosys, my sense is that majority of the selling would now be behind us. Now, I was flagging up the data that I think on Thursday, the last trading the previous week, there was almost an 8.5% jump in the open interest for Infosys, which has not been the case for the stock at least over the last many days, which means that the anticipation was that in the stock would open with a kind of a gap down performance, because on Thursday the stock was down 2.5%. Today the open interest has jumped to I think at one point when the stock was at 1200 levels, the OI had jumped up to more than 15 to 18%. That has now shrunk back towards 11%, which means that there has been so there's short covering which has already started off for Infosys from the 1200 mark. So I think 1200 could now act as a decent short-term base. I think the stock should try and fluctuate at these levels, may try and go into a bit of a time-wise correction, but I think 1200 would now be a good support for Infosys over the near term.
Jay, hi, good afternoon. Thank you so much for making time and speaking with us. Your take regarding a couple of these FMCG companies which are definitely outperforming. Nestle, I don't remember when we have seen a move of around 5% on that counter, and then ITC now sitting at record high levels past 400. The FMCG stocks, ITC and Nestle.
FMCG index is concerned, then I would say, yeah, sure. As far as the FMCG pack is concerned, I think the overall outlook here is bullish, and ITC has broken out from a consolidating range of almost 10% from 395 to 365 is what we saw ITC consolidating since past couple of trading sessions, and it has provided a breakout above that range. From here on, I think ITC is heading towards 425 on an immediate basis, and thereafter 440. So these are my short-term targets for ITC. And now I think that 395, 390 is a good support range out there. So among all of this entire FMCG pack, I think ITC is offering a good risk to reward.
Kunal, for a stock which was just at the bottom of the barrel is now at the top of the heap. ITC is at a life high. Is the risk-reward ratio still favorable in buying ITC, or it's one of those under-owned but now an overbought stock?
And now I think it's become more of an over-owned stock at levels of 400 approximately. So and now it's a matter of time frame and risk reward and position sizing. So for traders who are looking out for more quicker returns, I don't expect that to happen for ITC because of the way the stock has run up. I think now the move which started off for ITC in the last maybe 1.5 odd year has started off from being a daily breakout to being a monthly breakout. Now it's engulfing into more of a quarterly breakout for the stock price. So what matters over here is the time frame at which you're looking to buy the stock and hold the stock at current levels. You can't be going all out at 400 levels because of the way the stock has run up, and the risk reward may not be in favor to initiate a strong buy at current zone. But I think if you try and drop your position sizing, then the risk reward could be materialistically in favor for you. So what matters over here is more of a long-term time frame horizon from current levels. Even if you're aiming at say 480 to 500, which is a decent 25% upside for the stock, I don't expect that to happen in a matter of maybe a couple of months or a couple of quarters. I think that should probably pan out maybe in the next 1.5 odd years. So if you're okay with that kind of a time frame, then it makes sense to buy the stock at current levels.
Okay, well, today, of course, is all about Infosys and the kind of brokerage downgrades have come in. We're still pondering about whether after this 10 to 12% fall, whether Infi becomes a buy or not just yet. It's important to note that Infosys has actually breached the target prices or the most conservative target prices as well for brokerages today after that 1225 or 1220 thereabout level that it struck earlier today, which was its intraday low. The other stock, of course, in focus is also Cummins. Bank of America has downgraded the stock to an underperform from the earlier buy. They say that the current risk reward is pretty limited. They've cut the FY 24-25 estimated EPS by nearly about 2% odd. And Cummins is the stock which I'm talking about that also is languishing in trade as we speak right now, down about 3% at the day's lows. The other one, and we've been highlighting this entire list as to how the HNI activity has been in the quarter gone by, and especially in the month of March and month to date. Where are the stocks that you've seen maximum buying and selling coming in? So another one, Precision Camshaft, and Vijay Kedia has bought a near 1% stake in this particular company, Precision Camshaft. That stock will just come up for you on your screens. Let's see what that is up to in trade. Typically, when you have a marquee HNI name backing the stock or news of someone getting into the stock or checking in, you do have a big reaction, and 20% higher for Precision Camshaft. And interesting names coming in the entire HNI portfolio.
Yeah, so you look at Abacus, Sunil Singhania, they've bought 2% stake in Uni Parts. What the company is, it's into It is a mechanical company which essentially is in car parts. You've got a reputation, essentially is an engineering company. What was one of the last purchase of Vijay Kedia a couple of months ago? It was Elecon Engineering. So they're buying essentially in the entire nuts and the bolts industry, so to speak. What's interesting for me is that if you look at a lot of HNI investors, the classic old boys who've always used the market numbness to their advantage, a lot of HNI investors that have actually bought in the last quarter rather than they've sold in the last quarter. Whereas the retail activity was down, trading volumes took a dip, FIs were selling, market have gone through a patch of no return. That's the time when you have to treasure hunt. And you have to treasure hunt when you get decline. And the sentiment gives you a great entry opportunities. So whether it is Ashish Kacholia, a few stocks he's bought couple of last couple of days, or whether it is Dolly Khanna, or again Vijay Kedia, Abacus, or Pharma for that matter. Amansa has now increased their stake to 3% there.
Yeah, Laurus Labs.
Laurus Labs. That entire API business has no takers right now. Immediately after COVID, the demand for pharmaceutical and product intermediaries was so strong that DVs, Laurus, granules, they just hit out of the park. Now it's a forgotten story. So you buy the bad news, you buy the bad patch, and that's what some of the HNI investors have done.
In fact, let's pull up that link as well from our researcher earlier today. I don't know if we can just quickly bring it up, and let's see. Sharad is here to talk about what the HNI activity has been and who's bought what and sold what in the quarter gone by.
Well, yes, interesting names coming in, and of course pharma names and capital goods are popping up, and over here astute investors are in focus. Moving ahead, Suven Pharma is actually in focus. We can see Amansa Holdings has entered with a 2.56% stake, and for Laurus Labs also Amansa Holdings has actually increased their stake by almost 40 basis points. Apart from this, even for Laurus Labs, we have Akash Bansali of Enam increasing his stake from almost 1.14% to 1.33% stake. Even in the new land space itself, we can see Vijay Kedia promoted company Kedia Securities also increasing their stake. In the small cap space also, we see Uni Parts in focus, was recently listed also, and over here we can see Abacus Group actually entering with almost more than 2% stake in the company. Same thing applies for Precision Camshafts also, where we see Vijay Kedia has entered with almost 1% stake in the company, and the stock has been also buzzing very strongly in the day's trade. Apart from this, also ace investor Mukul Agarwal has entered into two new companies in the small cap space, Denora and WPIL, and also Ashish Kacholia would be in focus as he has actually increased his stake in Finutex Chemicals, and also his stake has increased in phase 3. Apart from this, also lastly I would like to point out Copran would be in focus, where Madhukola has actually increased his stake by almost 1%.
Okay, so that was about the shareholding patterns being changing and marquee investors checking into some of the counters. But Jay, what's your take regarding the capital goods sector today? Of course, there's a negative brokerage note coming in on Cummins, but then the question of valuations is always there. But as far as the chart patterns go, the likes of ABB, Siemens, L&T, where are they headed, you believe?
Well, I would say that, this space has already seen a good run up, and it has recovered also quite well. As far as L&T is concerned, the stock broke out of a triangular pattern in the last about a few trading sessions ago, and now it's just retesting that pattern. I think that L&T has a good support around the levels of 2100. Until those levels are maintained, there is a very high chance that we can see the levels of almost 2350, 2400 going forward. As ABB is also concerned, the overall trend out there is bullish. It's just that these stocks can consolidate for a time being, within 4 to 5% range. Either it is Cummins, Siemens, ABB, L&T. These all stocks can just consolidate, but the overall medium to long term is definitely bullish out there.
Okay, so that's the take coming in as far as some of these capital good names are concerned. But on that note, slipping into a very short break with the news that the market is holding on. In fact, from the lowest point of trading session, we have seen quite a bit of recovery.
All right, now we are off from the day's low, but it's not any kind of a shade of green at least. Benchmark indices may have recovered 100 points from the day's low, but you don't have any large trends per se. I'll tell you what is holding on. AU Bank. AU Bank is up for the second day on the trot. Where is disappointment coming from? I think HDFC Bank numbers were not that bad. which would warrant a 2% sell-off. In fact, we were discussing in the morning that HDFC Bank versus ITC, it would be HDFC Bank versus Infosys. It has turned out to be a day of HDFC Bank and Infosys rather than versus. Jyoti Vardhan Jaipuria, founder and managing director with Valentis Advisor, joins us now. Jyoti, good to have you back. Haven't seen you in a while. What's keeping you busy?
Yeah, markets have been keeping you busy. They've been volatile.
My friends who are Kunal and Nuresh, they've been saying markets have been so boring in the last 3 months, nothing to do. It's been a rebound market. So what really kept you busy then? My technical friends are saying it's been a boring market.
Yeah, so that's what we like, Nikunj. We like markets which are boring so that we have time to do our research, because we take a long time to cover each company. We spend like 2-3 months on each company before we buy it. So we like boring markets because it gives us some time to do our work properly.
This boring market. You didn't hear my question, is it? What have you bought in this? Yeah, I thought as much. What have you bought in this boring market?
Okay, so what we've been buying is, so generally like we not changed our theme too much. So we had 2 themes for the last 15 months. One is we have been like buy local, avoid global. The other is within local, we prefer investment plays to consumption plays. So both of these things we still continue to hold. We not changed it. And today all these software results are, probably vindicating our view to some extent. But like one theme which we've been adding over the last 3-4 months is there are lots of stocks which did badly last year because commodity prices shot up. So basically the raw material to sales and the margins took a hit. And those things are probably looking attractive now because one is the stocks have underperformed a lot. Second is commodity prices are coming down. So we think there'll be a reversal of the margins. And so we'll get normalization of margins going forward. So some of these are like, one obvious name is cement, which, cement companies have struggled to hike cement prices. But just the cost savings means that like in this quarter, you'll see 150 to 200 rupees of EBITDA increase just coming from the cost savings. That's one segment which we've been looking at. The other segment is ceramics, where again, gas prices have shot up a lot, but now gas prices are coming down. And, these people have increased their product prices also a bit. So that's going to help them. Third is wires and cables, where again, copper prices have been coming down. So under the raw material price, they are facing some better situation. So it's, things like this where you're probably going to get some margin increase coming from cost savings, which are attractive to us.
The side of the coin, Jyoti, is also what to avoid in this market. What is it that you're steering clear of?
So, we've luckily been not into software. So, and that's been through like last 15 months. It hurt us a bit in between when these stocks bounced, but we generally stayed away because for me, like the visibility of the future is very, very low. And if the companies don't have visibility because, the customers are like cutting costs, cutting people there. The second thing we've been avoiding has been all the global commodities. Because for us, again, if there's a slowdown in the world and, China slows down and US slows down, then global commodities will struggle. The prices may come down. And if they come down quickly, then, you tend to have earnings which come down very disproportionately because operating leverage for people is very, very high. So these are the 2 segments we've been avoiding. The third is, consumer staples, which generally we are avoiding not because we don't like the companies, but we think that the valuations are still very, very expensive. They become cheaper than what they were because they've underperformed a lot over the last 2.5 years. But even at these valuations, we don't find many ideas which are very convincing there.
Consumer stocks are expensive and they were expensive, and I keep ITC out of the equation. HUL. In a market where markets have moved from high expensive stocks to quality stocks and value stocks, HUL was one of the biggest gainers. The second biggest gainer in the Nifty last year was Mahindra and Mahindra, and the third biggest gainer was Britannia. So it's not that markets are not liking these stocks. FIs were selling, markets are rotating out of high P stocks to low P stocks. And yet Britannia and HUL have given you great returns. Why is that?
Yeah, so, last year, Nikunj, was obviously the thing where whatever FIs didn't own, they were the ones which held up the most. So if you see, it was some of these FMCG stocks, it was some of these public sector companies did well also last year. So it was things like this. Autos, of course, was something which we bought also, and I think most people bought in a big way. But the consumer stocks were the ones which went up by, like I say, it went up by stealth. When nobody really owned them, maybe people didn't buy in a big way, but nobody sold them because most people didn't own them.
Take as far as HUL is concerned as well. But Jyoti, I'm intrigued to ask you about the capital goods sector as well. But before I do that, let me go across to my colleague Vamakshi, because Bank of America came out with a fresh note on Cummins and they have an underweight call now. They've downgraded the stock. What's the reason? What's the rationale? Let's go across to Vamakshi to understand it better.
Well, absolutely. That downgrade that has come in from Bank of America on Cummins India is the reason why the stock is declining in trade today. Bank of America believes that there could be a sharp increase in sales over the next 2 quarters on pre-buys, and that has already been priced in. Now, what they're expecting is that the transition to CB, IB Plus is more technical. This could actually lead to a price increase of over 50%. And this could in turn lead to an adverse impact on sales post the first quarter of the financial year. The exports, which contribute nearly 1/3 of the sales for Cummins India and therefore are a significant portion, could disappoint on the global slowdown. Now, the growth could also be impacted from commodity-focused geographies such as the Middle East as well as Africa. Bulk of margin expansion of nearly around 560 basis points is now behind us. They're expecting to see 90 basis points of margin expansion from FY23 to FY25, and that seems to be largely baked in the current valuations. In fact, they've cut their FY24 and 25 estimates by around 2%. However, they're quite constructive on the stock in the long run given the ongoing capex cycle. They, however, believe that the overall risk reward is unfavorable and in fact it is limited, and on the back of those factors they've actually downgraded their rating on Cummins India from buy to underperform. They've also revised the target price, cut the target price from 1,758 earlier to 1,434 per share. So overall a downgrade that has come in from Bank of America on Cummins India, and that is the reason why the stock is declining in trade today.
Tata Com has recovered 2% down, 1% up. That's a move of 3% from the day's low. Indian Hotel, well, up 2%, down 1%. It just continues to chug along. But the stock which has really caught everyone's attention now, suddenly last 15-20 minutes, is I think Kotak Mahindra Bank. HDFC Bank is down, but Kotak Mahindra Bank has suddenly shot up. Jetakar, is there a big convincing breakout in Kotak Mahindra Bank? Haven't discussed this one in a while. Jay, Kotak Mahindra Bank?
Sure, Nikunj, yeah. So as far as Kotak Bank is concerned, definitely, this stock has provided a very nice breakout, Nikunj, and the kind of gap up opening which we saw a couple of trading sessions back, and now the stock is holding well to that gap up support. 1800 on the downside now on an immediate basis, I believe that is a very crucial support. Until we see Kotak Bank trading above the levels of 1800, we don't have any major resistance, at least until the levels of 2010, roughly maybe say 2000 to 2010 range. We don't have a major resistance. So this is one bank which I think Nikunj will continuously provide support to the bank Nifty, and along with that, we also seeing some good momentum coming back into the PSU sector. So PSU banks maybe. So among the private sector banks, Kotak Bank is looking good, and PSU banks along with that is also looking really great.
Your take as far as Kotak Mahindra Bank, and what's the disappointment today in HDFC Bank? Because 20% growth year on year, that's what it's been delivering. Yes, if you're looking at glass half empty, they have declined sequentially with respect to the profitability. But what do you think is ailing the sentiment on HDFC Bank? Jyoti Vardhan, the question is for you.
Oh, sorry. Okay.
Sure.
Yeah, so, and it's true for probably what will happen to some of the other banks also. One is there's a cost pressure which we've seen, and because of the cost push, the cost income ratio has gone up. The other is there's some, pressure on the NIMs which are coming. And even for the rest of the banking sector, probably over the next 2 quarters, that's going to be the challenge, that the stocks have done very well. And there will be some NIM pressure because, the deposits which reprice with a lag are also going to start repricing. You had like a great period earlier where the, loans were getting repriced, the deposits were not getting repriced. So NIMs had expanded a lot. So probably like the challenge for the banking sector will be over the next 1-2 quarters, you'll start seeing NIM compression in a lot of these banks which will come in. Having said all that, we still are positive in the banks because I think the credit growth is going to be very strong, and NPL pressure is going to be very weak. So, NPL provisioning will be low. So we still continue to like the banking sector.
In the banking sector, Jyoti, what are the favorites?
So, we've generally been playing what I call the corporate banks rather than the retail banks. And we continue to like most of the corporate banks because, that's where you'll get a bulk of the delta change because they were the ones over the last 3-4 years where we saw a lot of this NPL pressure coming through. And that's why, they were getting hit on their earnings. Next few years, there'll be no NPL pressure really in some sense. And so that's where the big earnings growth will come through. So, and these are relatively much cheaper on a price to book basis. So that's been a real focus. We generally avoided with these high quality retail banks and we've been generally avoiding them.
Okay, HDFC Bank 1666. Kunal, it's for a stock which had just made a new high. It was cruising along very smartly. It appeared in the morning it would have another great day, but 2% selling. Calm before storm, or we can ignore this as a ripple?
No, I think it's more of buy and rumor, sell on news. The build-up towards HDFC Bank was quite attractive. The stock had run up, I think, 150 odd points in the last 2-3 weeks. So it went into the results with a very strong positive bias, and I think it opened at a fresh life high, 70.25. The last I'd seen on the stock, and post that you've seen the stock tapering off for for those levels. We've seen this phenomena for many of the other names. For example, I think last week or so, L&T also made a fresh high about the 2300 mark, then it corrected and now it's back towards the 2200 level. So I think it's the way in which the markets are poised, and for many of the chart structures that we tend to see a life high being broken out, and the stocks they tend to correct, consolidate for a few more trading sessions before they make a strong comeback. So I would probably attribute HDFC Bank, HDFC Limited into similar kind of a patterns. For HDFC Bank, in case if the stock corrects by another 50-60 rupees and comes back towards that 1600 mark, that could be an attractive territory to buy because the risk reward would back to be in favor for the stock, and from there we can expect another 1720, 1725 as an upside for HDFC Bank. So buy on dips closer to that 1600 mark.
Okay, that's the take coming in on HDFC Bank. But today, the star performer from within banks, of course, is SBI. And besides that, there's RBL Bank, which is holding out very smartly. A good, solid 5% move is what you're seeing on this one. So that's holding out very well. Kotak Bank as well, not looking bad at all. 1.6% higher there as well. And then, of course, there's ICICI Bank, which is holding on to that 0.5% kind of gain mark. Jay, just very quickly on the charts for both SBI and RBL, considering they're the ones which are the leaders in the pack.
As far as SBI is concerned, definitely this stock has provided a very nice breakout today. I mean, about the levels of 535, SBI seems to be towards the levels of 555, 560 in the short term. The outlook here is bullish. I think that 535, 530 will act as a very crucial support. As far as RBL is concerned, it is yet to provide a breakout. I mean, it has got a resistance around the levels of 160. So it can back further in the levels of 160. If it moves beyond those levels, then definitely, we can see further a move in the levels of 185. Else, we can see RBL consolidating. But SBI has clearly provided a breakout.
On that note, we'll thank Jyoti Vardhan for joining us today and talking to us about the market setup. As of now, it's looking all right. It's not looking too bad a picture. There is recovery as far as from the lowest point is concerned, and Bank Nifty is holding up comfortably by the gains from the public sector bank as well. Time now to slip into a very short break, but as we do that, we leave you with the visuals coming in from Apple's first owned store in the country. It opens for general public in Mumbai tomorrow, and then there's one lined up in Delhi as well in the Saket region. So, important day, important event, and it looks quite a swanky one as far as the entire setup is concerned.
Swanky and huge. Yeah. So, yeah. In Mumbai, if they could pull up that size of a store, that's remarkable. But can't wait to hop across. I'm sure Nikunj would.
I'm not planning to buy anything in Apple.
Not buy.
So the temptation.
To,
I mean, it's an experience.
Yeah. Window shopping, it's fine.
Yeah. I mean, whatever little bit I've traveled and some of the Apple stores I've been to, it's really an experience. All of them are classy. All of them, the displays is absolutely amazing, and
all the stores from inside look the same across the world.
Yeah, but their stores have a unique identity. I mean, what they stand for. I was looking at the Apple playlist. There is a separate playlist which they have for Bombay and Delhi. It's absolutely amazing.
One of their largest markets.
Actually in India, their market share of the total smartphone market is not even 10%. And when we talk about Apple is still considered to be a very luxury and aspirational phone. Looking at the per capita income, Our per capita income is less than $3,000. Chinese per capita income more than $10,000. US per capita income $30,000. So in India, the affordability factor I think still makes an aspirational Apple phone very, very aspirational. I think we are reaching there, but we are not there yet. It really amazes me that if I look at two great American companies, Amazon built on the promise of giving you something cheap, Apple built on the promise of giving you something expensive, but it will be backed with an experience. And they both are the finest companies in the world.
Loyalty that Apple has, nothing can match that. Okay, we could go on talking about Apple. We'll take a very quick break and we'll talk about stocks in the last lap of today's session. Back with closing trades right here on ET now. Not looking bad at an index level, 17,757. You've got SBI powering ahead. You've got FMCG back in the fours. So Nestle is now scaling higher by 4.5%. Britannia holding up 2%. There's, of course, ITC as well, part of that FMCG index as well, which has made a fresh high for itself and above its 200 DMA. That's ITC in trade for you. Interestingly, ICICI Bank and Reliance as well picking up ahead. Reliance is now holding up 0.5% or so. So that also is sort of providing a bit of a cushion to the index, if you will. IT continues to be a drag. HDFC Bank continues to be a drag. Haven't seen any meaningful recovery in that pocket just yet. But let's bring on board Manoj Muralidharan and talk about where he sees trading opportunity. Manoj, hi, afternoon. Your call on the index and any individual stock that you think is trade-worthy right now?
Good afternoon. I believe that this series of April has been more of a short covering. If you remember, at least this is the last 7 to 8 odd sessions where both the Nifty and Bank Nifty, majorly the Nifty, has seen short positioning. The FI desk, at least, they were short roll positionings of almost 85 to 80%. Now that has trimmed down to a good 60-61%. So 48 to 60 is an average that we are seeing from the FI desk. So we believe that that excessive shorting or that short which were there in the last 90 odd days, 3 expiries, has trimmed down, and now we are almost at a formidable level. Now, looking at the index, Nifty also, we believe now it's a time we might get into a consolidation. So 150 points on either side, we believe that 17,900 and 17,500. This is where the trade might be. Though the VIX is down, it's almost at 12.5%, but still selling a 17,650 call and put option. I guess the combination gives around 170 rupees. That is a good trade that can be done. But stock specific, because I was mentioning the banking stocks and Bank Nifty, there is a correlation which goes into the quantitative analysis. At 2.31 is where we started this series of April, and almost we are at 2.38. That is, you simply divide the Bank Nifty by Nifty. So the ratio is at 2.38. Now we believe that some index management might come in between the Bank Nifty, because we have a lot between the private sector banks and the PSU. So that is exactly the reason why we are seeing good traction and buying in SBI. And we are positive on SBI. We believe that the stock has a potential of almost 574 to 575. A better route is you can buy a 540 call option. I guess you get it for 10 rupees with a stop loss of 4. That can give you a very good handsome target of almost 20 to 21 rupees. Now, talking about Reliance that you mentioned, that we believe, yes, in today's trade, even though after Infosys results and after that gap down opening, which was almost the same what the ADR showed, we believe there is buying happening, but we still prefer Reliance, and we are expecting a good 68 to 70 points more upside on Reliance. So at least somewhere close to 24.48 to 24.50 is where Reliance might trade in the next couple of days. So we believe SBI and Reliance becomes a buy call at this point of time. The index might be into a consolidation.
Tata Motor DVR is up 2%. Tata Motor is up down 1%. Let's look at the 52-week change for Tata Motor DVR and I think Tata Motor. We were discussing this, I think, Kunal, on Thursday, that DVR a better stock to buy. Let's actually map that. 52-week changed for Tata Motor DVR 7%. Tata Motors now, please. 8%. We may like it, we don't like it, but they're connected to the hip. We don't know which one will go up first. But ultimately, on a 2-year basis, 3-year basis, let's put the 3-year chart also for both of them. Will just come up as we speak. They're joined at the hip.
Yeah. So, of course, on a longer term basis, you will see the trend for both of these stocks to be very, very similar. And I think the discount in the discount for the DVR is what tends to be the major reasons for fluctuations for the stock price. Like for example, we were discussing on Thursday that the discount for DVR as a like-to-like comparison with respect to Tata Motors is around 5 to 6%. So there could be a possibility that DVRs may rally up 5%, 6% higher or better as compared to Tata Motors in a short span of time. So I think today, for example, Tata Motors is up some 0.5%, DVR is up 2.5%. So some part of that discounting has probably been covered up. You might probably see another 3%, 3.5% covering up for their underperformance. But then I think broadly, when we look at 6 months, 1 year plus kind of a time horizon, the trends and the trajectory for both of these stocks will be very, very similar. So it's more of risk reward, it's more of the position sizing as well as the comfort which one gets in terms of trying to pick up the stocks, because eventually the trends for both of these names are very, very similar.
Kunj Bansal, good afternoon.
Good afternoon.
Most of the experts who've come on the channel today are saying that from last 1 year they underweight IT. Have you also been lucky? Have you also been underweight IT?
So we need to differentiate that the performance or outperformance comes because of the market momentum or market force, so by way of the genuine selection of stocks and of course sector weightages. Post facto, it's easy to say a lot of things. It's the same IT sector which was a very decent performer, in fact an outperformer, I think hardly 2.5, 3 months ago, and it did consistently well. So instead of getting taken in by the shorter term movement, we need to kind of very clearly distinguish that if we are looking at the market from a trading or a short term point of view, we take a call accordingly. And if we are looking at a medium term point of view, we take a call accordingly. Now, even for a medium term, let's keep in mind that we are at an index level which is almost at a 2-year ago level. So to that extent, for a medium term investor, also index hasn't moved anywhere. Of course, in that 2-year period, there have been many sectors which have been outperformer, many have been underperformer, and many have gone through both the phases of outperformance and underperformance.
So that's the take coming in as far as what the positioning has been for the IT counters. But the other space that we want to talk about is also the entire, food delivery space. Zomato is one stock which is coming under pressure. Remember, a lot of their dark stores of Blinkit are shut when it comes to the northern capital region of the country. But separately, there's also the news flow happening with respect to CocaCola, which is now entering the food delivery space, and the entire space could be heating up. We understand that the global beverage maker is eyeing a minority stake in Thrive, which is a lesser known food delivery platform, but nonetheless, the backing coming in from CocaCola could be fairly important. Let's go across to Sharad to understand what the exact dynamics are of the industry at this point of time and how big could really this Thrive investment be.
Well, yes, in focus we are having Coca-Cola, as they will be acquiring a minority stake in Thrive. Now do remember that Thrive is an online food delivery app, and of course it comes on the lower end when it comes to the commissions. Now the important thing is this will be Coca-Cola's first investment in an Indian startup, and also the company will be pushing the customers to order only Coca-Cola's beverages via the Thrive's online food delivery app. Now we did speak about what the industry is, and do remember that a 19% growth is expected for the Indian food delivery market, and from the share of the online food ordering, that is expected to double to almost 24% by FY25 as per a report by Motilal Oswal. Now looking at the market share of these food delivery players, 55% is contributed by Zomato, while the remaining 45% is Swiggy, making it a duopoly market. Apart from this, also there have been a lot of food delivery companies which have exited the space in India and actually given a stronger moat to Zomato and Swiggy. This includes Uber Eats, Food Panda, Amazon, Ola Cafe, and also Scootsie. So most of them have actually exited the Indian markets. But there are certain triggers going ahead, and Swiggy in the unlisted space would be in focus as it prepares for its IPO by September 2024. Recently, Invesco also cut the valuations of Swiggy from $10.7 billion to $8 billion. And also due to restructuring before they plan to sell their kitchen service business valued at $40 million. However, the company was having a lot of resignations being announced in the recent times. Now, apart from this, also Zomato in the listed space, there has been a correction in the stock itself. but brokerages are expecting that by FY25 the company hits its break-even numbers. Apart from this, the key trigger would also be Zomato Gold, which has been reintroduced, and it would be a re-rating trigger. But lastly, there is a cause of concern going ahead, and that is due to the Blinkit acquisition.
Right, okay, that's the take coming in on some tough competition perhaps for these food delivery platforms. But Kunj, just wanted to understand what's your take on Zomato. Many are finding merit in investing in this, or for that matter, many other new age tech platforms after the recent bout of correction that's taken place.
So few things. One, just because some international major takes a minority stake in an Indian startup, change the business model. It might, if at all, increase the financial strength, assuming that the investor will probably keep on pumping more money. He may not. The business conditions, the business model, which has been tested and tried and strengthened by the existing players, remains the same, and the existing players will be the bigger beneficiary instead of a newer or a smaller player trying to come up just backed by the international investments minority. Coming to the market and the performance of all the new age tech companies, food delivery companies, the fintech companies, which came in with IPO about 1 year ago when the market was supportive and a lot of global money was coming in, a lot of domestic money was also supporting. Market was in a euphoric phase. I think we have moved far away from that. A lot of reality check has come in. More importantly, parallelly, what has happened is a lot of profit-making sectors and companies, their prices and valuations have taken a sharp correction. So any incremental money which comes in into Indian market now will have two options. Do I get into tried and tested 5-year, 10-year, 15, 20-year-old business model, a strong brands, cash flow generating, profitability track record? Of course, because of the recent inflationary issues and other things, recent past there has been a slowdown. Or do I go into loss making, probably visibility of loss for 3 to 5 years, new age companies which on any valuation parameters will still look very high? I think the large part of investment will go into the first set of companies wherein, as I said, a lot of prices and valuations have corrected. The tried and tested business models and brand is strong. Just as an example, let's say consumer durable sector. So that's what will happen, and I don't the performance or the stock price performance for new age companies will be more with the orientation of trading, short-term trading, a little bit up, little bit down. But I don't think sustainable outperformance is going to come from there.
Sustainable outperformance might not come from this fintech and food delivery world, but for us, there's a sustainable growth when it comes to the key rates or the room tariffs for a lot of these hotel companies as well. In fact, in an exclusive conversation with Nikunj, Anthony Capuano, the president and CEO at Marriott International, discusses about their expansion plans in India and whether they are looking at some inorganic acquisitions as well.
We are, in fact, at the HICSA conference earlier this week in Bangalore, I talked about a goal we've set for ourselves that by 2025, between open and pipeline hotels, we'll have at least 250 hotels. And I think that really just reflects us getting started. Today, India is our fourth largest market in terms of our footprint. I've had the privilege to spend week with our India team, and I can tell you they are keenly focused on moving up the rankings. We're very bullish about the political stability and environment here in India. We're excited about the broad range of diverse markets and experiences that the country has to offer. We are excited about the passion that our owner community has to continue to invest and grow in India. We talked at length with your Prime Minister yesterday and with your Tourism Minister about what a strategic focus area travel and tourism represents as part of the broader macroeconomic priorities. And so India, from a travel and tourism perspective, has a very, very bright future, and we want to be a meaningful part of that. We are humbled and excited about the fact that we have the largest footprint of rooms across India today of any lodging company, and we want to continue to grow our portfolio here in this really exciting set of markets. Well, Again, I spent a great deal of my career on the transaction side of our business. So we're always evaluating, we're always having conversations. What I can tell you, and you mentioned it in the context of your question, with our industry leading global scale, I don't feel the need to do M&A simply to gain scale. But I am also quite intrigued if I see a set of geographic markets where I'm not satisfied with the pace at which we're growing, or if I see a gap in our brand architecture that represents an opportunity. I think we have a demonstrated track record of being quite effective in identifying and executing M&A transactions that are accretive to our shareholders, accretive to our brand portfolio, and offer new opportunities for our associates and our guests. And we'll continue to evaluate those opportunities every day.
Right. Kunj, just on the prospects of hospitality and hotels in particular, as to where or how much potential do you see? Because like you just heard from the Marriott International CEO as well, for the next 2 to 3 years, he sees immense visibility. We were just chatting with the management of Lemon Tree the other day, and they said that from consumer perspective, if you're unhappy about the ARRs right now, watch how it's going to grow in the next 2 years.
Yeah, so it's indeed fortunate that the whole industry, the hospitality, hotels particularly, have come out of the sharp recessionary business conditions that they were in because of the COVID. And let's keep in mind that we are currently going through the 4th or 5th or whichever wave of COVID. Hopefully, it shouldn't be that severe. But nonetheless, we have seen the business travel increasing. We have seen the personal travel increasing. We have seen the weddings and other festivals again getting bigger and bigger in shape, and that has resulted into the increased occupancy rate for the hotels. Of course, alongside has come in the increase in the ARR, which are likely to continue to go up. Let's also keep in mind that along with every demand increase, the supply increase also tends to come into the place. And it's the same Indian players who have in the recent past announced multiple new hotel launches, large part of those either by taking the lease on the existing and by renovation. So it's not that it's going to take a longer period to start or a longer capital investment. Once the balance of supply and demand keeps coming in, the significant increase in ARR could continue to be a challenge. But nonetheless, there is an expectation that given the current demand, there will be some. Now, what has happened parallelly is in anticipation of that, we have already seen most of the hotel industry stocks having moved up and their valuations having moved to the upper end of the historical range. So that's where challenge comes. As we were discussing that the markets have been flat in last 2 years, the index level at large cap Nifty and Sensex is where it was 2 years ago. But in that period, there have been a lot of outperforming and underperforming sectors. So hotels has been one sector which, because of the increased demand post-COVID issues, has seen that kind of an outperformance. So for me, it's a puzzle whether we will continue to see sustained outperformance. Of course, the business conditions are likely to continue to improve.
That's a take coming in on the hospitality segment. But Manoj, your take regarding any of these names from the hospital sector and even the public sector banking space today, that's quite excited. Any names that is catching your attention?
Yeah, so I was just mentioning that we all know that even in Bank Nifty, SBI has a good weightage, almost, if I'm not mistaken, closer to 26%. And we believe that this pair which goes on between the private sector and the PSU in the Bank Nifty, so this is the time there would be some more money coming into the PSU part of it. Though if you see the last 1800 points in the Bank Nifty has been led more by the private bank. So as I mentioned, SBI has a potential of good 18 to 20 more rupees. So we're expecting at least a good target close to around with a 540 strike call option, at least a 20 as a target. So that comes to around 574 to 76. But then apart from this, I guess IT is a time, even though Infosys, post result and the 10% down, we have actually seen good volume weighted average price traction in intraday also. There is a possibility the stock might bounce all the way to 1322. So let's say 1240 to 1250 still becomes a buy. Let's say with a stop loss of 1210 and a target of 1320. And in today's trade, I guess cement as a sector, at least Grasim as a stock, has seen renewed buying, and we're expecting that the stock has a potential of a good 28-30% that comes to at least a short term 2 to 3%. So 1728 becomes a good buy for Grasim with a stop loss of 1710, and we expect a target close to 1750. to 1760 on the stock.
Right, okay, let's get in some BTST trades as well going before we hit closing bell. Kunal, what's on your list?
So a couple of buy calls. RBL Bank stands out to be, more of a repetition from what I discussed last week as well. So would suggest a buy 170 as revised target. Stop loss trail hard to 145. And the second would be AB Capital. The stock has gone into a very strong breakout. Managed to break past about the 162-63 mark, which was the previous hurdle. So would suggest a buy 170 as a target. Stop loss at 159.
Right. Manoj, what about your BTST ideas?
I guess I'll still go with Reliance. I guess that is one stock has a good potential, and that is a favorite stock when you see an index management happening. I believe there is some money which would come out of the banking and the sector wise, and we would see some money flowing into Reliance. So Reliance becomes a buy. We prefer using a strike call option also, but then we have a good target of around 48 to 60 or rupees with 24.50 as a target. It becomes a buy as a BTST as well.
Manoj, I'm not sure if you've taken your view on IT. Is there any stock there that becomes a buy after the correction? Risk reward is favorable on any of the names?
That was for me, you saying?
Yes, Manoj.
Yeah, so as I mentioned, even today, the Infosys, the weighted average price concept works really. After a 10% correction, we have seen that 1244 to 46, that becomes a weighted average price of which the buying has come. So as per derivative, you see a follow-up buying coming up every time we see the weighted average price goes right. So we believe that in Infosys, there is a possibility of 1308 to 1320. So at 1245 or 1250, the stock price, it still becomes a buy. The stop loss should be 1210 on the stock for the target of 1308.
Okay, let's begin winding up then for the day. Manoj as well as Kunj, we let you go on that note. Thanks as always for joining in. We're definitely